Imagine looking at your phone right now
Okay.
and watching your bank balance tick up by a fraction of a cent
Right.
every single second you're at work.
It's a crazy thought.
No more waiting 2 weeks for a paycheck. No more employers holding on to your money. What if your salary flowed to you exactly like water from a tap?
It completely changes how we think about earning.
Welcome to the Deep Dive. Today is March 6th, 2026.
A very specific, very important date.
Yeah, incredibly important, because today marks one of the most critical structural shifts in the history of the project trying to make this reality.
The final token unlock.
Exactly. The final token unlock for Zebec Network and its native token, ZBCN.
It really is a watershed moment for them.
So we've pulled together a really diverse stack of sources for you today,
You're looking at crypto market analyses, technical guides.
from platforms like BitGet, Gate, and Femex.
Right, alongside Zebec's own white papers and blogs.
And our mission today is to synthesize all of this, to unpack exactly how Zebec Network is attempting to rewrite the $100 trillion global payment sector.
100 trillion. It's a massive target.
They're trying to turn these static, delayed lump sums into continuous streams of value.
Bridging Web3 with traditional banking.
And we are definitely going to break down what this massive March 2026 tokenomics shift actually means for its future.
Because it changes the whole economic model.
Okay, let's unpack this legacy financial system first.
Yeah, we have to start there.
If you look at the U.S. Automated Clearinghouse Network,
The ACH network.
right, the system that handles almost all of our direct deposits, it relies on batch processing logic from the 1950s.
It's basically ancient technology.
We're sending AI into space, but relying on banking tech from the era of black and white TV.
It's wild when you think about it.
It takes days for money to actually settle.
You submit a file, a clearinghouse reads it hours later.
And eventually, maybe the funds move.
Right.
And between paychecks, employees are basically forced to give interest-free loans to their employers.
You do the work on Monday.
But you don't see the liquidity for that work until 2 Fridays from now.
And that specific friction is the core of what Zebec is targeting.
Right.
They're introducing something called streaming finance.
Which is part of this broader PayFi movement.
Yeah, payment
Okay.
finance. And the math from the sources on this is actually pretty striking.
Let's hear it.
So if you make a $5,000 monthly salary
Okay.
in a streaming finance model, that translates to roughly $0.0019
So about 0.2 of a cent,
flowing into your wallet every single second.
just continuously ticking up.
24/7. And the macro implications of that are huge for capital efficiency.
For the employee, obviously, immediate liquidity,
Right. You avoid predatory payday loan fees entirely.
because you have the money the exact second you earn it.
But for the employer, it's actually just as compelling.
How so?
Well, in the traditional system, employers have to pre-fund these massive payroll accounts days in advance.
Oh, just to make sure the batch processing clears in time,
Exactly. With streaming, they hold on to their capital
meaning they can earn yield on it?
right up until the exact millisecond it's dispersed.
Okay, but the technical engine to actually pull that off,
It has to be incredibly robust.
because you're processing per second settlements across thousands of employees,
So originally, Zebec started on Solana,
which makes sense for speed.
definitely, but they realized that relying on a shared network was too risky.
Because of network congestion.
Yeah, if there's a surge in regular DeFi traffic or some massive NFT mint.
You can't have people's per second payroll getting delayed because someone is trading meme coins.
Exactly. So they built their own dedicated architecture.
The Nautilus chain.
Right. The industry's first modular layer 3 blockchain.
So it leverages Celestia for data availability.
And uses ZEC rollup technology for high-speed processing.
But why is that specific architecture mathematically essential for PayFi?
It comes down to gas fees.
Transaction costs.
If you're sending a microtransaction every single second, the cost has to be practically zero.
Otherwise, the fees would just eat the payment stream alive.
Right. You'd lose your whole salary to network fees.
So Nautilus drives those costs down to what?
Often well below 1 cent, fractions of a cent.
Making the continuous streaming economically viable.
Exactly.
But having the best tech in the world doesn't matter if nobody uses it.
True.
And this is where their market strategy gets really clever. They aren't just waiting for companies to adopt crypto.
No, they're taking a very proactive approach.
The sources outline this massive Trojan horse strategy.
Yeah, bridging Web 2 and Web 3.
They have this investment arm, Payroll Growth Partners.
PGP.
Right.
Yeah.
And They're literally just acquiring traditional payroll companies.
It's brilliant. If a company doesn't want to buy Web3 software,
Just buy the company and upgrade the plumbing quietly.
the end user doesn't even need to know it's blockchain.
They just get faster settlement on the back end.
What's fascinating here is how this scales into the traditional financial system.
Let's talk about December 2025.
A huge milestone. They joined the Nacha Payments Innovation Alliance.
Nacha, the group that governs the entire $85 trillion U.S. ACH network.
Sitting right alongside JP Morgan and Wells Fargo.
That's some serious institutional validation.
And they parlayed that into a partnership with NatPay.
The National Payment Corporation.
Right, who handles $170 billion annually.
For over 300,000 clients.
And this all connects through the WageLink app.
So an employer can use traditional ACH, FedNow, or Web3 stablecoins.
All from one unified platform.
So they're literally hardwiring this into the U.S. banking system.
But getting paid in crypto is only half the battle.
Right. The spending part.
Yeah.
The last mile problem.
Exactly. If you get paid in a stablecoin but can't buy groceries.
It's useless.
So in February 2026, they partnered with Lattice Finance.
To launch the first MasterCard on the Canton network.
And Canton isn't just any ledger.
It's an institutional network used by Goldman Sachs and the DTCC.
So they're bringing institutional liquidity straight to retail spending.
And the Zebec cards are live in, 138 countries?
Yeah, across silver, carbon, and black tiers.
Allowing you to instantly spend over 150 different crypto tokens.
For your morning coffee, the fiat conversion happens automatically.
Here's where it gets really interesting, though.
The physical hardware?
Yes. Moving beyond software into DePIN.
Decentralized physical infrastructure networks.
Zebec calls their initiative ZEPIN.
Deploying proprietary point-of-sale devices directly into retail shops.
They've got this credit card-sized NFC smart box.
And the portable ZBCN terminal.
But why? Why build physical hardware when you already have MasterCards?
It's all about merchant incentive.
Bypassing the credit card fees.
Exactly. When a merchant installs a ZEPIN device, they get an NFT network identifier.
Okay.
And Zebec rewards them with ZBCN token streams over 36 months.
To offset the cost of the hardware.
Right. Plus, they get volume-based bonuses.
So it completely slashes the high merchant fees from traditional credit cards.
It removes the middlemen entirely.
Now, to understand the fuel running all of this, we have to look at the tokenomics.
The transition from ZBC to ZBCN.
Back in 2024, they did a 1-to-10 token split.
Multiplying the supply to 100 billion.
Usually a split like that is just a trick to make the token look cheaper to retail.
But here there was a real structural reason.
It was.
Enabling granular whole number gas fee calculations.
Oh, because of the microtransactions.
Right. If you're processing fractions of a cent every second on the Nautilus chain.
Trying to calculate gas fees using tiny decimals of a higher price token creates drag.
Exactly. Computational drag on the smart contracts. A larger supply of lower priced tokens allows for clean, whole numbers.
Which brings us back to today, March 2026.
The final token unlock.
What does this actually mean for the network?
It means circulating supply hits roughly 99%.
So the dilution risk is just gone.
The inflation phase is over. Early investors can't dump newly unlocked tokens anymore.
And at the same time, they've got this buyback and burn mechanism.
Right, which shifts the model to deflationary.
So product revenue.
From payroll fees, debit card swipes.
Automatically buys ZBCN off the open market and permanently removes it.
Burns it. And the data shows buyback volume growing at over 70% annualized.
So the supply is fixed and real-world revenue is constantly eating away at it.
Making the token increasingly scarce.
Let's look at the market snapshot, though.
The current valuation.
Yeah, because ZBCN is trading around $0.002 right now.
0.2 cents.
A market cap of roughly $200 million.
Down about 70% from its all-time high in mid-2025.
So there's a bit of a disconnect here between the price and the fundamentals.
It reflects an early-stage valuation.
But the fundamental,
Gacha, NatPay, cards in 138 countries.
those are mature enterprise metrics.
And on-chain data shows smart money accumulating ZBCN in Tier 1 wallets early this year.
Positioning ahead of this final token unlock.
Right.
But we always want to be impartial here. We have to address the risks.
Absolutely. The competitive moat and the execution risks.
Let's start with competitors. You've got projects like Onyx Coin.
XEN, yeah. They focus heavily on institutional ledgers,
And superfluid.
who provide great developer SDKs for streaming.
But the sources suggest Zebec's real moat is vertical integration.
They own the L3 chain, the consumer cards, the banking rails, and the physical hardware.
But that vertical integration is also a massive execution risk.
Huge risk, fusing all of this into their planned super app.
Combining staking, cards, and payroll into one interface.
It's incredibly complex to build.
And they aren't just fighting other crypto projects.
They are up against massive traditional incumbents,
ADP and Gusto.
companies with endless resources and decades of trust.
There's also the issue of opaque adoption metrics.
Yeah, we don't have public number on exactly how much payroll volume is actually flowing through yet.
We hear about the partnerships, but the verifiable on-chain fiat volume isn't totally clear.
And if the buyback and burn is going to work, it needs massive verifiable revenue.
Then there's the psychological anchor of the token supply itself.
100 billion tokens is a lot.
Even with the dilution risk gone, reaching just 1 cent.
Requires a fully diluted market cap of $1 billion.
It's a massive hill to climb.
It demands sustained exponential growth.
So what does this all mean for you, the listener?
It's about fundamentally changing our relationship with time and compensation.
It's not just a crypto trade. It's an infrastructure play to make money as fluid as data.
And if they succeed,
And the global standard shifts to streaming per second income.
it leads to a really profound question.
Let's hear it.
How does that change the concept of debt?
Oh, wow.
If you are paid by the second, could your mortgage, your car loan, your Netflix subscription?
Be paid by the second too.
Imagine a world where the concept of a monthly due date simply ceases to exist.
And the late fees that come with it.
Exactly.
That is a fascinating thought to leave on. Thank you so much for joining us on this deep dive. Keep questioning how the systems around you work, and we'll see you next time.